I don't think that the Nasdaq has topped here. I mean, I think we will see some volatility, and I actually expect some kind of volatility because when we get closer to a top, it doesn't go like all bull days and bull weeks up, and then it just drops all of a sudden. That was it. It always gets more and more choppy into the top, and I think that kind of volatility is what you see when the bears and the bulls starts to fight it out up towards the top. And at some point, the bears are going to win.
The war in Iran has kicked back up. The markets are getting choppy. Is a blow-off top coming soon, or are we headed for a crash? And how will we know? Hello and welcome to Milk Road Macro, the podcast that knows that I could reuse old jokes in these intros, but I keep making up new ones anyway. I'm your host, John Gillen. Today is Wednesday, June 9th, and today we are joined by Henrik Zeberg. Henrik is a macroeconomist renowned for his expertise on business cycles. He currently serves as the head macroeconomist at Swissblock, and he recently published a book called The Monetary House of Cards, the bust of the everything bubble caused by central bank hubris. As you can imagine, I am always very excited to talk to Henrik. This is going to be a really great episode today. So if that sounds good to you, make sure you like and subscribe. Share this episode with somebody who's going to enjoy it. Also, as a reminder, the market is going kind of nuts right now. Our analysts have been making a lot of trades. We had over 20 trades made by the Milk Road Pro analysts this week. Some of them are buying the dip. Some of them are waiting to see how things play out. But for $1, you can see everything that they're doing, all the trades they're making. If you join Milk Road Pro today, you will get 7 days in there and you can cancel anytime. Come join Milk Road Pro and see what we're up to. Today's episode is brought to you by Cape, the privacy-first mobile carrier, Nexo, earn interest, borrow, and trade crypto, and Kalshi, where your takes finally pay out. And without further ado, we're going to get some takes from Henrik Zeberg. Welcome to Milk Road Macro. Henrik, how are you?
Thank you so much. Great.
Henrik, I thought a good place to start would be to just revisit the framework that you've been calling for a long time, which is sort of this, I think you called it like this 3 phases of a bear dinner, which is the first is a blow off top, and then a crash led by technology stocks, and then moving into a period of stagflation. I wonder if you could just start us out with like a high-level summary of this outlook here and just give our audience an overview of the framework you're taking to this macro landscape that we're in.
When it comes to the blow off top, I think that is materializing since we spoke the last time. You don't need to look far in the stock market and in the markets around the world also to see that that's been materializing. We've looked to the Kospi index, look to the semiconductors, look to, everywhere you go, you'll see that there are these crazy moves. And that was exactly what I was expecting. And then people say, yeah, but it does not blow off top because it's not come to my particular asset or Bitcoin in particular. And I think that is I think we will see that as well also for crypto, because these are just the most risky assets and they're going to be the last in the queue, so to speak, and this is really where the animal spirit kicks in when you have that kind of move. So we don't need a lot for rotation to come out of semiconductors or the Kospi or any indices around the world before we could see the move into assets like crypto assets in the US. And I think that's the next phase of it. So the blow off top is developing, and it's, like it or not, it's something that has been taking since 22. Actually, if you look at the market since then, that is really when they started to go nuts. So we had the initial spike out of the Corona situation. Then, when the first part of inflation was over, we then saw that move up in the in risk assets, and they just keep pushing and pushing, and for longer than I expected. I give it that, but I've never called the top at any point since 22. So we're still there. But we're getting closer. We're definitely getting closer. And I'm actually saying that we are at a point now where I think there are markets in Asia that have topped already, risk assets and risk indices. And I think we will see that rotation now into the US. So we are, need to ask about the framework, but this is more the outlook in terms of the about that three dish kind of course that I was laying out. And so we are in that. You can call it that appetizer we're in right now, and then we will see the main course, the real story unfold when this starts to collapse. Because this is, people can talk as much as they want about this not being a bubble. This is a bubble, and this is as big as it gets so far. We haven't seen anything bigger than this ever. And when people say, yeah, but there is earnings this time, but can look to all sorts of metrics, and you'll see that this is a bubble, and it's the biggest we have seen ever. Bigger than 1929, it's bigger than 2007, and it's definitely also bigger than the biggest one we've seen, which was 2000. And people just have to relate to that. And if we when they do that, then we'll also see that what we should expect is that it's going to burst. When it bursts, you're going to see something that is different from what you saw in 2000, because in 2000 you only had a tech bubble. This time you have a tech bubble where the housing market is also affected and the consumer is affected, which it wasn't. The consumer wasn't really affected in 2001. So the situation is not the same like that, and it's not the same like in 2008, 7 and 8, because we didn't have really a bubble there. You had it in the real estate, but you did not have it in the tech market as well, and in all of in risk assets in general. So I think you're going to see a combination of that, and actually that's also why I think it's going to get worse. And the biggest bubble in the world is going to create the biggest crash in the world. That's how it is.
Do you fancy yourself an analyst and or a content creator in this space? Well, we want you. Specifically, if you live and breathe tech equities, Milk Road could be the home for you. We're hiring for 2 positions right now, analyst and content creator. So check out the careers page below.
Gotcha. Okay. Thank you for that framing. That's very helpful. Henrik, one of the things I love about you is you're simultaneously one of the most bullish and most bearish analysts that I've ever spoken to. So I want to go through a couple of these things in a little bit more detail. And I want to start with something you said about the consumer. As the health of the consumer is for you a big indicator of the underlying economic health in these markets. Walk me through what you're seeing in terms of consumer health right now. Why is this so important for investors to pay attention to?
I don't understand why people don't pay attention to it. Because if you look to the markets and to the economy, 70% of the economy is the consumer. 70%. So if you had to go somewhere and you blindfolded, you had to pick something out, and out of 100 people, you would pick one out. There would be 70 people out of 100 that were the most important thing of this economy, and then I can't understand why we're talking about the 1 or 2 people that is, within AI, or, this is just so fragmented or so skewed to one side, because it's not a good story. It's not interesting. Just talk about Mrs. Johnson back there, in the 19th percentile in terms of, income, and talk about how she is doing. Because we want to have the headlines. We want to talk about AI. We want to talk about how we can send data centers into space and SpaceX IPO and all these fancy stuff. Like we wanted to talk about the new economy back in 2000 and say how this was going to change the world. And we were right. We were right. And everybody who was talked about it were right. But the problem is just that is not what drives the economy. And the economy right now is driven by Mrs. Johnson and what she can see and feel in terms of her wallet. And right now, I can tell you she doesn't feel good. So the housing affordability is very low. Her savings rate is down to 2%, 2.6%, which is, by the way, the lowest we have seen only going into the financial crisis. The more people ever live paycheck to paycheck. So if they miss, one paycheck, they are deep trouble, because they can't, make a living then, or they can't, make ends meet. We see some, so this is the reality of things. And if they get a $1,000 kind of, extra bill, you can be the car breaking down or something like that. They are, it's going to be a big problem, but they won't be able to. The median consumer will not be able to handle a $5,000 extra bill. And I mean, things can happen. So we are in a situation where the consumer is probably at the worst place they have ever been outside of a recession. And this is this is not headlines, but this should be the one thing on the top of headlines every day, saying we are in a bad place with the economy because of the consumer. But it's not a good story. Who wants to hear about that? And that's the unfortunate situation when it comes to the economy and the markets. We don't want to hear about things that really matters. We want to talk about Musk and what he says and about setting things up, but he doesn't drive it. An AI investment cannot run an economy. So I hear people saying, well, this is an investment-driven economy. Well, there's nothing as an investment-driven economy. There's an investment boom. We've seen that before. We saw that with the telco investments, and we saw a boom in there. We saw it within the internet, and a boom into the 2000 also. But it doesn't drive the economy. And this time around, we have seen a boom in investment going into AI. It's not as big as people say, but that's for another day. If you look to the capital expenditure and as part of GDP, we have seen similar to that. But when we look at this, people are just talking, and it's just narrative, and there's no really people holding onto facts. The problem is with that, you can have all the investment in the world you want, but if that does not materialize into a return on investment, well, then it's not going to be a good thing. So we better hope that all these investments they're going to bring a return, because if they don't, well, someone is going to be a little disappointed there. And the only one who can bring a return out is the consumer. By the end of the day, you might buy it from one business and the next business, but businesses by themselves do not earn money. They earn money by selling things to the consumer at the end of it. But it's really about the consumer. You cannot drive an economy on investments. You can boost an economy on investment for a certain while. And if you do not see that trickling into new jobs, then you have a problem. If the new jobs are not coming up, so let's say now you invest in AI, the problem is right now that when you invest in AI, you don't do it to hire more people in. You do it because you actually want to reduce the number of people, because you want to become more productive. That is the whole story about AI. So when you do that, you don't necessarily go and say, oh, by the way, we need 2 more people. That's not how it works. You will actually see if you can reduce it. And that's also the problem. So right now you're seeing an economy there that is running on this investment boom. And that is why we really haven't seen the decline in the economy. And then we have these headline numbers when it comes out on the non-farm payrolls, for instance, which is it's the most simple thing in the world to double click on a non-farm payroll and then see what is it actually that we're getting. We get 172,000 jobs. First of all, we need to remind ourselves that last year, and I was sitting on other interviews as well, saying these numbers I don't get one bit. I said that in Q1 and Q2 last year. We can go back and take a look at that. And I said, I don't get it because it's, that's not where the economy is at. And then along came August and we saw 1 million jobs, disappearing because they were never there. It's because they have to calibrate with, I think it's with insurance numbers or something like that. So it's really, and then these numbers, they didn't exist. And also non-farm payrolls is both part-time jobs and full-time jobs. So they don't ask for that in the non-farm payroll survey, which happened. So what has happened this time around is actually you saw apparently 172,000 jobs in May, but 79,000 jobs, full-time jobs, were lost in the same month. So make that fit. You've lost 79,000 full-time jobs, but you had a job creation of 172,000 jobs. It doesn't add up. And that's why I'm saying these numbers are completely, a mirage, and they will be adjusted down the road. Call me in August and we can take a look at it. They will be revised, and right now you're actually seeing that there was since January of 2025, so a year and what is that, 5-6 months, you've seen a loss of full-time jobs. 1.9 million full-time jobs has similarly been lost in that period. 1.9 million out of 171 million jobs. That is not a great situation. Similarly, duration of unemployment, time people are unemployed, is moving up. We are now 50% higher than going into the financial crisis. So people are not looking. And this is what, again, we have something that is a boring story because it doesn't, go quick like this. And it's not Trump saying that and the market goes like this. So it's the endorphin kind of, triggering things that are interesting to look at, but it's not what runs the economy. And that is what people don't get. Business cycle tells us where we are tells us where we are, and we are right now at a situation where the economy is rolling over.
Gotcha. Okay. So thank you. There's a lot in that answer. And I think the thing I was going to ask about was that jobs report. So I'm glad you commented on that because a lot of people have been pointing to that saying, look, we're adding jobs, the economy's strengthening. You're saying if you look under the hood, it's not as rosy a picture as people are painting it as. I want to ask about your views on inflation because we've gotten the June CPI data just this morning. It's in line with expectations. The headline, I think, was 4.2%. But the people have been pointing at this accelerating inflation and accelerating job growth and saying the AI capex is driving a reacceleration in economic activity, at least in certain sectors. And I'm curious your thoughts on that. What do you think the signal inflation is sending is, and how serious of a concern is this 4.2 headline CPI print?
I'm not concerned one bit about inflation, not one bit. And again, people are missing so many of the medium steps or the steps in between there, because they say inflation is bad, then the Fed will not supply us with more of our a drug in terms of liquidity. Well, first of all, inflation is a problem for the consumer. Let's just start by how things are really connected here. Inflation is a problem for the consumer because if you have high inflation, you're going to see that the consumer will be having more difficulties in actually buying their normal groceries. That is the problem with inflation. That is why the Fed has a mandate on keeping it at bay. However, inflation by itself, when the economy is when the economy is rolling over and the consumer is already in a bad situation, is not inflationary. Inflation is not inflationary. Inflation can actually be deflationary. What do I mean by that? Try imagine you have a certain amount of money you can spend every month, and now you see that the price on oil, for instance, or the gas actually rises. What are you going to do? You're going to cut down on something because you don't all of a sudden get more money in your hand because inflation goes up. It's not like you get now, oh, that's nice. Now, yeah, I get like $200 extra a month. No, that's not how it works. You've got the $1,000 you can spend. So what you're going to do is that you need to cut back on certain other things. And that is the problem, because when inflation is high, then you'll see the people need to cut back. So right now, what people are not understanding is that an inflationary number, inflation going up, is a problem when the economy is accelerating. Then you have a problem. That's like in 2022. That's where you have a problem, because the economy was actually accelerating because you've been pumping all these money out, and you had, all businesses hardly couldn't follow up with the demand. That is a problem. It's not a problem when the economy is slowing, which it is right now. And then people pointing to the non-farm payrolls, which I just talked about, which I don't trust one bit. Going into 26, the last 5 months of 25 was an average job creation on the non-farm payrolls of minus 9,000 jobs per month. All of a sudden, in 2026, we saw an acceleration, boom, exploding up to these 170 something thousand, which we have seen in the last few months. Again, understanding that these numbers will be revised. And where did that acceleration come from? And then people come up with all these stories because they don't read under the hood. They don't look to the one thing, as I said, the full-time employment, and not just the non-farm payroll. And if you look to that, you're losing full-time employment, jobs, and you are creating jobs that will be. So you're looking at a gauge, which really you don't know if it's you're going 60 miles an hour or 100 miles an hour or 20 miles an hour, and then you will know later. Oh, we were not going with 100 miles an hour. We will actually go 20 miles per hour. So you cannot use that as a gauge to and the Fed that does that, I know, which is extreme, to think that they actually last year thought that the economy was as strong as it was, when it really was not strong. And the same is the situation right now. So I think I'm not worried about inflation at the time where the economy is rolling over. I'm much more worried about the situation with the consumer right now, that they have had that this after whammy now with the oil prices going up, which is going to hit short term. That's a supply shock, and that is a problem short term. But that supply shock is going to create demand destruction. That demand destruction is the consumer saying, "Oh, okay, I'll need to cut back," and there are certain things we can't buy, and that has a multiplicating effect, which will hit the rest of the economy. So I'm not afraid of the inflation going up. And one thing again, people also do not understand: inflation always moves higher into the last phase of the economy. Go back to 2008 and see inflation. It was up at 5.4 or something like percent of that. That was in 2008 when the Fed was cutting like crazy. Remember that the Fed was cutting like crazy already in January of 2008. Inflation was moving up to 5 point something in the midst of 2008. Why did the Fed cut like that? Because inflation is not a problem in the moment when the economy rolls over. And at that point, the economy was starting to lose jobs every month. So the artificial number we have right now of 170,000 jobs is creating this uncertainty, which I think Powell has been in. And that's why he didn't dare to start to cut, because he did not want to be the one who creates another Weimar situation like in Germany in the 20s, right? So he was afraid, looking at those numbers, that I do not dare to cut anything. And I can kind of understand that, because the gauge is simply broken and doesn't work. And that's why he is. We now in a situation where the consumer was, seeing. I'm pretty agree with Trump there. They should have been cutting for a long time ago to support the consumer. So inflation is not a problem. The problem is that we have way too hawkish a stance on the monetary policy at this point. And the longer the consumer stays underwater, and a bigger percentage of the consumer, the longer they will take to recover. It's like if you have had this for a year or 2 years, and you've been up to your neck and just managing things, right? Then it will take you longer to start daring to take on that next new loan to buy a new car or whatever it is. you will wait a little extra because you need to see if things are now. If it's like a 3 or 5 months thing, okay, then you'll recover more quickly. And this is what the problem is, that the consumer now has been underwater since 22 almost, right? And when we finally get that whammy from the economy, when the investment boom all of a sudden cannot drive it any further, why do we think that the economy is then all of a sudden going to pick up like a massive way? I don't think it will.
Okay, Henrik, I think that's a lot of information for our audience to digest on how you see the economy there. But I like this emphasis on the consumer and the consumer health as opposed to some of these other headline metrics that people focus on more. Let's pivot to the markets now, because this is something that's been divergent, right? Like the underlying economic health is showing some strains, but the markets keep going higher. And I'm curious your thoughts on this. A lot of analysts have pointed to rising forward earnings estimates for a lot of companies in the S&P 500 that are sort of leading this rally. And using those forward earnings estimates to justify these valuations, saying that this bull run that's driven by AI stock investment is going to continue. Do you agree with this analysis? Do you trust these forward earnings estimates? And I can already see you laughing a little bit, but why don't you trust these forward earnings estimates?
I think this is the problem of getting older and remembering things, and actually try and understood the things back 25 years ago, and then having to listen to these things again. And I think that's why it's becoming so, annoying almost to sit and hear, oh, but this time it's something different, right? First of all, when you have earnings, you can have businesses earning all the money in the world. It doesn't drive the economy. I mean, you can have peak profits, and you normally have peak profits into the top of the business cycle where the recession begins. So right into the recession, because businesses are good at cutting out people, and they say, oh, now we need to lay off people because we need to earn money. They need to make sure that they make ends meet. I don't know what the next analyst is talking about in terms of looking at these valuation levels here and say, oh, but this is justified by this and that. The situation is we have a extremely overvalued stock market at this point, to crazy extensions, and that can go on for some time, and so at some point it cannot any longer. And you will see that into the final phase of this, and that's why I called it blow-off top in 22, because it was clear to me we were getting into that phase where you would see these kinds of development. This is what happens, and that's the cyclic of the understanding of the business cycle is so important. And it took longer. Let me just say that first of all. It took longer, but that's fine. That's been just because of all the money that's been circulating and all that and all the stimulus we've seen. But anyway, now we're coming to a point where you cannot squeeze more out of this. And you'll say, NVIDIA is earning good money and so on. Yep, it's right. But again, if you believe that the economy is driven by the businesses, I'll just, ask you to go back, take a look, take the profits on businesses and see, did you have recessions anyway? Even when businesses were making good money? Yes, you did. What were the driver of that every time? That was the consumer. When the consumer stopped to spend, then you have a problem. And the consumer right now is down to 2.6% savings rate, where you normally would be about 5 to 8% or 10%. So 2.6 is low. Why are we there? Because the consumer is under stress. And when they are under stress like this, the businesses will not continue to earn good money. I mean, again, it needs to come from somewhere. So I don't know what the analysts are talking about. And I know that they did not foresee the S&P around 6,000, 7,000 back in 22. They were, at a different place. I said we would go to this kind of level, and then we would see where the top would be, and we are now heading closer and closer to it. And I was also expecting, I don't know if you've been following that, but I was actually expecting in March also that we would have more or less a vertical kind of move in the market, because that's what we have seen elsewhere, and also because of the structural setup we have. And that's what we have seen with the NASDAQ. And that goes on for some time until it doesn't any longer. It's a nice Eiffel Tower we're building, and at some point it's going to come down. And I don't give much for the narrative that comes from analysts and so on. I honestly don't think it's worth its money.
Okay, well, I think we'll have to find out what happens with all of that. SpaceX is about to have its IPO. There are plans for Anthropic and OpenAI to follow quickly behind that. I think this will happen around the time this episode is released. Do you think that this wave of IPOs might mark a market top for equities in this cycle, or do you think that there's still room to go even higher from here as this sort of euphoric bull run continues?
There's a reason why they all come out now. We always have that also into the major talks. We'll see a lot of IPOs, and obviously people are, these people doing the IPOs will, the businesses will obviously try to milk the market as much as they can. And they're certainly doing this time. I have to give it that. I mean, the valuation levels for SpaceX is just extreme. Will it market on the day that we see the IPO? No, I don't think so. I think that they will have attracted enough information. You can see also we've been bombarded with information of how great this is going to be, and the data centers now in the space. And I even got intrigued by that and say, wow, that sounds interesting. That maybe SpaceX could be a good idea, right? Long run, maybe. At these valuation levels that we're here about with SpaceX, absolutely not. And could it rise 10, 20, 30% even, despite that? Sure, because there will be attracted a lot of, capital. I can see there was a lot of interest in it. And so surely there are going to be a lot of money coming into that and could be pushing it up. And the whole speculation around that, and people don't look to that. There's a reason why it's Warren Buffett's been pulling money out of the market for some time, and he knows when the pot is getting a little too wild and it's time to go home. And I think I am not better than him, definitely. So I think it's I would look to him and say I think it's time to go home. It might be that there's an extra dimension to this party here, but you don't need to be in all of it. And I definitely don't want to be one of those having the severe hangovers tomorrow, because there will be hangovers, because this is not driven by fundamentals at all. It's driven by animal spirit. And that's also why it can go on for some time more. I don't know how long, but I think the levels that we are looking at is not far off where I've said that the market talk could be.
Your phone carrier knows more about you than your best friend does. Where you go, who you call, when you sleep, and they're selling all of it. AT&T, Verizon, T-Mobile, they've all been caught leaking data or cashing in on it. And your VPN, your encrypted messaging app, they can't fix what's broken at the network level. That's where Cape comes in. Cape is America's privacy-first mobile carrier. Same premium coverage you'd expect, built with privacy from day one. Your phone's network identifier rotates every 24 hours, so you look like a different subscriber every day. Call logs are deleted after 24 hours. You get 2 encrypted secondary numbers for signups and 2FA included in your plan, plus SIM swap protection that puts you in control of your number, so no one, not even Cape, can hijack it. Use code MILKROAD at milkroad.com/Cape for 33% off your first 6 months. The way we build wealth is changing. Stocks, savings accounts, real estate, that playbook is getting rewritten in real time. Nexo is the platform built for what's next. It's an all-in-one digital wealth platform where you can earn interest on your crypto, borrow against it without selling, and trade a wide range of assets, all in one place with 24/7 support and institutional-grade security. Oh, and by the way, Nexo is back in the US, with new US clients getting 30 days of Wealth Club Premier access. That means elevated interest rates, lower borrowing costs, and crypto cashback on trades. Benefits usually reserved for loyalty program members. Get started at milkroad.com/Nexo.
I want to ask you about something you mentioned the last time you were on the show, which is that you watch a lot of the Asian markets, Asian economies, to get a leading indicator of where the global bull market is going, or when it might be ending. And I wanted to get an updated outlook from you on that, because I think the Korean stock exchange has been stopped because of sell-offs a couple of times now this week. And I'm just curious your updated outlook on that and what you're seeing in those markets as a forward-looking indicator for what might be to come in the U.S. markets.
I think it's interesting. Every time we see a vertical stock that goes vertical, we just say, "Oh, this is fantastic." I always get worried when I see that. Say, "Okay, this shows us that there's something an end coming to this," and then it goes on for weeks and weeks, and people are just becoming more and more bullish on it. And I think what we've seen with the Kospi and elsewhere is that it's this is exactly the kind of move that you would expect into a very big top. And it never, ever, ever ends like going up and then it levels out. It always ends like an Eiffel Tower. It's more like how low it's going to go after. So yes, I do look to Asia, it's because there will be, and I also look to Europe, by the way. But it's normal that you will see some kind of lead from the Asian markets. It could be like from Nikkei, which I also particularly could see have topped. I think the Hang Seng has topped already in January, and when I say top, I mean a major top. And so there are other markets there that I think are important to look to. And the Kospi was just in a crazy movement. It's a very tech heavy in this index, so that makes sense that it kind of moved like that. So I think it sends us a warning sign now that we're starting to see that where the top potentially could be in. Does it mean that it will be in that for the US market? No, not necessarily. I don't think it will, actually, because the normal cycles will tell us that we will then see the rotation into US. Now, if you've been part of the Kospi and you've been I don't know, Samsung or something like that, and you then all of a sudden you start to see, oh, I'm up 400% on my portfolio. That's pretty nice. People are wise. They don't think it's going up another 400%. They say, oh, now I can actually take that money and I can put it into something else, which has not been moving this much. And then they will look to the US markets because the good old US is where we see the strongest economy, apparently, right? And that's what we hear every time. We hear that it's the US economy that is the strongest and they're going to stand the longest. And then you see that fulfillment because people are starting to put their money into the US. And that's the rotation that I see going on. In 2000, you saw the US markets topping out in March of 2000, and you saw the Kospi topping in January of 2000. That was 2 months before in the Kospi. So, and in 2007, it was actually like the Kospi topped in a month later, which tells us also that that's one of the indicators that tells us. I'm not saying that's the whole story behind it, but it tells us that we have a more like a tech situation like in 2000 than we have a 2007 situation when it comes to the markets. So, and that's also what the valuations are saying. So the situation is that, yes, I look to the Kospi and I say, if I see a top there, I can still see the US markets going higher with the rotation we could see going for some time. But it definitely is a canary in a coal mine falling down from its stick. And then we'll have to see whether the situation will be the same. I think it's going to be the same. But that still leaves us with the potential strong phase. And I don't think that the Nasdaq has topped here. I mean, I think we will see some volatility, and I actually expect some kind of volatility because when we get closer to our top, it doesn't go like all bull days and bull weeks up, and then it just drops all of a sudden. That was it. It always gets more and more choppy into the top, and I think that kind of volatility is what you see when the bears and the bulls starts to fight it out up towards the top. And at some point, the bears are going to win. Not where we are right now, but not so much later as from where we are today.
Okay, and I want to ask you about how to navigate this because our audience is a lot of very intelligent and savvy, but also mostly self-directed investors, and they're not Warren Buffett. They can't really afford to sit with $300 billion in cash on the sidelines. So a lot of investors are trying to figure out how to navigate these market situations because it does feel like a lot of these things are in bubble territory or at least overvalued. They've in some cases gone up several 100% in a short period. And yet there's also this risk of missing out on, like you said, a continuation of this bull run in AI stocks if you sell out too early. How are you navigating this yourself? Are you staying all in on stocks? Are you starting to take profits? Like, how are you thinking about this? How are you navigating this in your portfolio? And what would you say to the audience?
I don't think I'm necessarily the average person or the average investor because I follow this closely every day and I spend 10 12 hours every day in front of the screen, so I know what I look for, and I don't think there's one thing because if it was that easy, there are a certain set of things that you can be looking for, and these are some of those are the levels. But when it comes to this about feeling FOMO, as I said in interviews before the move in March, and I actually also put in some of my Substack publications, I said, I want to say that there is this move here because if I didn't say it and I say get out of stocks now, you would think after 30% higher that I'm wrong. But you don't need to participate in that 30% because it is a speculative phase, and that is what So if you've been part of it, I mean, Warren Buffett, he went in April, in March of 2009 and started to, just said when you're seeing things as deeply undervalued as they are right now, that's the time to move in. And you've been, holding on ever since and been adding on and so on. And I think the situation is now that we are coming to the other end of this. And that's why he now has been starting to pull out. And it's down to risk profile, whether you want to be part of that or you don't want to be part of it. And he has, obviously a portfolio size where he needs to start selling off a little time before, otherwise he himself can crash the market, I'm sure. But it's the thing is that people will be. The FOMO is the second strongest feelings when it comes to investment. So it's it's not as strong as when you lose money, but it's almost as strong as losing money. The feeling that you get there that, you feel that you're losing out on something, which is not as good as well. But sometimes it's okay. I mean, it's okay not to be part of the party if you know it's going to end in a bad manner. And there will be, and then start to look for the new opportunities because there will be new opportunities. It's not like this is the only thing, and you're going to jump in front of the steam, the train there or whatever it is that's coming against us, and you to pick up the pennies there. So look at the market, say, yeah, it's okay, it goes up 25%, but it doesn't mean you're wrong. It just means you're early, and that's okay. You can be early and come out and get out. If you're more risky, and I am definitely a little more risky on that, I think I see that rotation going on. It's almost too clear that it will happen, because that's the part of the animal spirit. And as people have been earning a lot of money, and they're going to seek into the next and the next and the next, and I also have certain indicators telling me when I think it's the time for the market actually to top out. And some of those are that you start to see it in Asia and elsewhere to top out first, and then you start to look to the next ones, right? But the situation is that I'm not the ordinary investor when it comes to that. I am staying in longer than most people should and would, but I will be out the moment when things are starting to, because there will be indications of, absolutely, and people just need to look. So I will not advise people on something, but I only say it's okay to feel FOMO. Don't lose money on it in the on staying in too long, especially not when things have been going up. And if you're up 200 or 300%, you've done well. If you're up, 100%, you've also done well. But do not, FOMO for the next 25% necessarily, because that's, I think it was Ray Dalio saying, this is the phase, the 20% where people just go insane. And I think you're going to see more and more of that. And you were already seeing it because you have the FOMO around AI already. And it's just going to get more insane, I think, as we go into the final phase of this.
Okay, so there are risks to getting out too early, but there's also risks to staying in too long. Everybody is going to have to reflect for themselves, figure out what's right for their portfolio. I think that's a pretty circumspect answer on that. Henrik, I got to ask you about crypto, because I'll be honest with you, I follow your work for a long time. I think this is one of the most wild takes I've heard, which is that you're still calling for this blow off top to end with a rotation into Bitcoin and digital assets here. Bitcoin, by many metrics, has been in a technical bear market now for close to a year, not quite a year yet. But you've stuck to this conviction throughout this bear market for Bitcoin, calling for this rotation and this blow off top. Walk me through the thesis here. Why are you so convicted that we're going to see a shift from AI stocks into crypto? And what do you see that's going to drive that catalyst there?
Animal spirit. It's not a catalyst. It's animal spirit, and you don't need much. So you have a 130 trillion stock market, a global stock market. And crypto, I don't know how much it is today, but is it 2.5, 3 trillion? 2 trillion. Okay. If you get 100 billion coming into, or let's say half a trillion coming into crypto right now, that will drive a lot. And there are indications that a 700 billion kind of move into Bitcoin into Bitcoin and crypto in general could drive this move here. Do I think that with the potential of a lot of cash, a lot of money, capital coming out of Kalshi and elsewhere, and moving into other markets, also from the likes of some of the Nasdaq stocks as well. I mean the FANG stocks and so on. Yeah, I do think so. I think that you're going to see that animal spirit coming in and sitting looking there at the Bitcoin and saying we can still see that moving up, and technically it looks like Bitcoin has put in a top, and I want to emphasize that I was wrong when I called for 170 and 180. I think it was the highest I ever said. I actually said 125 back in the days of 2000, and I said that was from when it was at 16,000, and I said 125,000. That means looks like it could be a top in terms of the Fibonacci extension, and it was 126, I think, right? I think that was the top. And I think we will look at that in retrospect here when it starts to head lower. But it doesn't do that in a straight line. And that's what people always think. It's like, something is dropping, it has to drop from right here on. It has already dropped a lot. And there will be, phases in that. I mean, even in the financial crisis, you had strong rallies in some of the stocks that were dropping. You had very strong rallies. This is Bitcoin at a time where you're going to see rotation coming in. And as I said, 700 billion, 800 billion coming into crypto world will do a lot. And even will create just that rotation, which will then push the market up even further. So I am not so worried about that. It's not going to see a rally in Bitcoin. The only thing will be how high is it going to go? And I think the 100,000 line is a psychological line. It's actually also becoming very much a technical line that could be making sense. So a bounce back to 100,000 and a euphoria around that, and talking about how Bitcoin is going to save the world again. I hardly can say this. I mean, so honestly, I think it's stupid. I have to say, I think it's stupid. And I want to say that out loud. It's stupid. There's no salvation in Bitcoin whatsoever. And people can talk about its limited supply from here on to end of days. There's nothing that can, convince me that that's going to be. There was a talk back in 1989 also about the limited supply of land underneath Tokyo and actually under the imperial palace back then. And that was the reason why it could go to infinity almost in terms of price. What happened to that limited supply? We know what happened. So people are talking like that, and it's I don't know, chit chat. And what we see is that it will drop, and it will drop because there is no you look at yourself. If you had three components here, you had cash, you had Bitcoin, and you had Apple stocks. And you were being met by a demand of, you need to pay back this loan now. First, you'll take your cash and pay back the loan. If you don't have cash, you look at Bitcoin or the Apple stock. And a reasonable investor would say, well, the Apple stock is generating a dividend every year of something. I don't know how much it's been over the last few years. And Bitcoin doesn't. And it's much more volatile. So I think I'll sell my Bitcoin. That is the rationale for what you will see. It is a more riskier asset. There's no doubt about that. And that means that it's a thing that can only move up if there is somebody buying it behind you. If there's not, it drops. And that's why it drops a lot. And you can see how it's been always when NASDAQ has been dropping, it's been dropping by more. It's a leverage beta play on the NASDAQ. So I think you're going to see that NASDAQ will drop and drop a lot into a potential crisis that could be coming, and especially if the dollar is going to move up as fast as I think it can. But it's not in a straight line, and that's the thing. And I think the dollar can drop further from here. The Dixie can drop to 94 or something like that, and you can see Bitcoin thriving in that. You can see gold thriving in that, and you can see the rotation also still going on, and that's where Bitcoin will have its kind of hooray rally. That move, by the way, and this is what people say, but why do you think Bitcoin is going to have a bounce and Ethereum is going to go to new all-time highs? Because that is normally what we see. We normally see that when Bitcoin only bounces, that is actually where Ethereum and altcoins are doing the best. And we can understand why. It's because Bitcoin doesn't steal all the thunder. It's like with the NASDAQ. When the NASDAQ was soaring higher, everybody was just pouring into that. And, we went on. But when it starts to kind of, level out and, people starting to think, maybe I should put my money somewhere else. So I think that is the rotational, part of the rotation that is now going on and will go faster and faster and faster. And that's why I think it's going to come to Bitcoin and Ethereum also. Could I be wrong? Sure. It looks like we have at least peak fear soon, or we could have a little more, but let's see what comes next week. But when it does, we also know that 4, 6, 8, 10 weeks is enough for the whole, for very, very strong crypto rally and an altcoin rally. And this is what people don't realize. You had some that was 4 to 6 weeks, and we just saw 200-300% on the altcoins or Ethereum. Can we see that? Yeah, sure we can. There's plenty of time for that. And I think that's the end game here. That's what we're going to see. That's the furthest out on the risk curve. That is where we're going to see capital going out. And it's not the whole chunk of money. It's not the people who have been. It's not Warren Buffett that is starting to say, "Oh, I need to buy Bitcoin." I can promise you, we will not. But it's other people, and they will see that, and we will see that at some. So I think it's it's not so much of a contrarian. I actually love to be the contrarian there, because then I think, okay, even though I don't like the asset that much, you're probably going to see that it can happen because people are calling it off right now.
You're listening to The Milk Road Show, which means you've got takes. Strong ones, I bet. But where do those takes actually go? Do you tweet them into the void, argue them in the group chat, or do you try to express them by buying a stock? The thing is, stocks move on like 50 other things at once, and that's where Kalshi comes in. It's a CFTC-regulated prediction market where you bet directly on outcomes like Bitcoin hitting 100K, Fed rate cuts, GameStop buying eBay, with a clean yes or no. We did a full deep dive on why prediction markets might be crypto's third product market fit moment. Check the show notes for the full report and claim $10 free when you trade $10 on Kalshi.
I want to get your thoughts on one thing here that I've heard a lot of people say, which is that now that we've had this rise of AI and the speculation has all been in there, this blow off top might happen, but it's going to stay where it has been, which is in the AI stocks. And the market has sort of like overlooked, forgotten about, and crypto has sort of missed this whole big bull run for the last 9 months or so since October in the equities markets. Do you think that there is anything to that idea that this like blow off top will happen in the equities market, but won't rotate into crypto because crypto's just sort of missed out this time? Like, what are your thoughts on that?
Why would it miss out? I mean, this is where people are coming up with these things because it didn't happen yesterday, and I'm tired of waiting, and I don't bother to look. So if you look at all the times you have seen Nasdaq going almost vertical, you've had quite a few times of that since 21, and actually before that, also in 17 and 18 and so on, you actually had some strong moves on Nasdaq. It started, let's say, there was one rally that started in late 21, and we saw the Nasdaq was heading higher for 10 weeks in straight, and Bitcoin was flat and actually dropped into the final week of it. And then it took off by 80%, whereas the Nasdaq moved by 7 to 8%. I mean, people, if you look to what we have this time around, you've seen everybody was bearish, the equities in March of late March this year. And I was not. I was saying we're going to have a vertical rally. And if you put 10 weeks on top of that, you're almost at the time where we are now. I'm not saying that's going to be a replay of that, but we're almost there. That's because the money first flows into one asset and you kind of feel, oh, I feel comfortable here now. Let's move on to something else. And I made good money. Let's move on to the next one. And, that's how it works. And then it doesn't move the moment that people then all these narrative comes up, and it's always there. So this wise guy coming up with some kind of narrative of, this is happening now because this and that, and then it goes straight against him. And, I think we need to understand that human psychology is moving from peak fear to peak euphoria. And you got to find yourself somewhere where we are in that. Right now, you are at peak fear for crypto, but you start in euphoria on the stocks. And when you start to see some pullbacks there, then you'll see the rotation going on. And that is what I'm suggesting. So I'm this about the crypto has missed out. It sounds like it's a human being that didn't catch the train, right? We're talking about millions of people. So it's not like just one person all of a sudden missed the train. I mean, that's not like that. So I think you're going to see that risk rally here is going to continue because we're not at the top yet. We don't see all the indications we would at the top, really the top in the US markets. And we only need 4 to 10 weeks in terms of a strong rally for this to go insane. And then everybody will forget again, and everybody will have been a bull all along. Like, go back in March, and I can show you my articles on this and say I was bullish, and I pointed out, and I even said this is going to be a very, very strong run, and we're going to. And people were killing me on X with that. Had to understand that I'm going to ruin my reputation. I don't know where the people are at today, but the same thing is now. People don't analyze. They don't look, honestly, and they don't, and they come up with all these sorts of narrative because it's kind of the feel good kind of thing, I think.
Henrik, I really appreciate you coming on Milk Road Macro. One of the things I've always admired about you is that you are very consistent, you are very convicted, you are contrarian. But whatever does happen here, like you said, you could be wrong. We'll have to see how it plays out. But I do admire the way that you've kind of stuck to your guns on a lot of these things, even when the market hasn't always confirmed it immediately. Where can we send people to find more of you and your work online?
Well, first of all, you can go to Henrik Zeberg on X and Substack, and we also have our SEM services and the Zeberg letter, which I just we'll be publishing today, actually, the version for June, where I'm also laying out this as like a 40-page kind of report that I do every month. And I go through all the business cycle and also the real economy, and to tell people that that's what matters. And then I go into markets and so on. You can find that on SEM at Swissblock, on the Swissblock side. So you can look it up on Google. But that's pretty much where to find me and to follow my work.
Henrik Zeberg, thank you so much for being on Milk Road Macro. I hope we can talk again soon. Thank you all for joining us. I hope you all learned something today. So until next time, stay safe, stay educated, stay bullish, and we will see you all on the next episode of Milk Road Macro. Thanks for being here, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.